Alright, so good day everyone. Welcome to another session of our Boy tutorial. And in today's session, we are going to be looking at accounting concepts and conversion as the topic under accounting. So if you're an accounting student or any student at all offering accounting as part of their course allocation, then there's a need for you to understand better what accounting concept and conversion is all about. Now here is the secret. I do tell people or students that if they really want to understand a course better, they need to understand the fundamental background, or let me say the fundamental principle, the concept, the origin of that course, so that when they go deeper into that course, they will have every underlying knowledge they need to trace it back to the origin. So if you're an accounting beginner, then you need this video, and if you're already you are good with accounting, you're also going to need this video, as I'm going to be providing the concept and also provide examples and explanation with for every concept I'm going to be mentioning. So let us list out the concept that we have here. But before that, what is accounting concepts? Now, accounting concepts are principles or laid down rules that are introduced by accounting regulatory bodies, which are used to guide them in preparation of financial statements. And accounting conversion, on the other hand, there are practices or customs that have been in existence over time, and they are adopted by accountants in preparation of financial statements. All right, so I'm going to be listing out the concepts that we have, and as well as the conversion, as we give examples and explanation to them. All right, so we have one: going concern concept. We have the dual aspect concept. We have the entity concept. We have the cost concept. We have the accrual concept. We have the matching concept, and we have the money measurement concepts. So these are the 7 accounting concepts I'm going to be giving explanation to in this video. Alright, so starting with the number 1 here, we have the going concern concept. So what is this concept saying? The concept states that a business should have a business should continue to operate into a foreseeable future, that is, into a future that we can see, a future that is realistic. And this can be applied. How do we apply this concept in preparation of financial position? That is, usually when we are balancing an account, that is for the year ended 2025, when we are balancing an account, we always introduce what we call the balance CD. Then if it is on the credit side, so we put the balance BD on the other side, that is on the debit side. Now, this is not done just because we just want to put the balance BD here. It is because we have the understanding as a business that the business is going to continue. That is, the business is not ending. Let us say, for example, we are creating this account, this one, for the year ended 2025. And after 2025, we still have 2026. So when we are ending the account in 2025, we put balance BD, because we know this balance BD will be introduced in 2026 as a balance brought forward. Meaning that for every account, for the closing of every account, we put balance BD, which signifies that the business is not ending. The business still has the potential to continue later on in the future. So the balance BD explains the going concerns concept, which is will be taken as the balance brought forward in the next thing. All right, so going concern concept is not only about that. This also improves, or let us say encourage investors. It builds investors confidence. That is, whoever is trying to invest in your business, they have the understanding that the business has this concept exists, which means the business should continue to operate into a foreseeable future. That is, you are not trying to liquidate at any time. So that is what we are talking about as the going concern concept. So, and this is the application in the preparation of financial position. All right, so we have the second one, the dual aspect concept. So what does this concept say? This concept states that for every transaction, two parties must be involved, and for every transaction, two parties being involved, this will take the both parties to have what? Two sides of accounts, two accounts. And we always introduce something which we have the debit side and the credit side. Do not forget, if I'm the one creating an account, I'm going to have two accounts reflecting the same transaction, and the other party is also going to have going to open two accounts reflecting the same transaction. And on the side of those accounts, we are going to introduce the debit and the credit side. So we say that the dual aspect concept is the foundation of the double entry principles, which state that for every debit entry there must be a corresponding credit entry, and for every credit entry there must be a corresponding debit entry. Now let me give an example. Let us say Annie Boy sold goods worth 200 naira cash. Now Annie Boy is a business, so Annie Boy business sold goods to someone, but I'm not putting that in that question yet. Annie Boy sold goods worth 200 naira cash. Now in Annie Boy's account, I'm going to open two accounts. In my book, I'm going to open two accounts, which is sales account and cash account. Since the payment is for the goods I'm selling is made in cash, so I'm opening cash account. If it is by check or bank or by transfer, I'm going to open bank account. Now these two accounts reflect it is dual aspect. It reflects the same transaction. Then I'm going to introduce the debit credit. Now this is not the end of this principle, and that's why sometimes I do give some people that feel like they understand accounting, or I just throw the question out to see if you really understand what this concept is talking about. Because you see, this is in the book of Annie Boy. I'm opening sales account and cash account. Now to whoever I'm selling the goods to, in his own book, so he's going to open two accounts, and in the side of his own book, while I'm opening a sales account, he is going to be opening a purchases account and a cash account too, because he's paying with cash. Now the question I said I do throw out is that the principle of double entry says that what? You should debit the receiver and credit the giver. That is, credit the giver, debit the receiver. And we understand that for every credit entry there should be a corresponding debit entry. Now when you make a transfer with your phone, with your bank app, to somebody, when you send 2,000, when I'm sending 2,000 to somebody now, I'm the giver. I'm sending money out. I'm the giver in the real sense that I'm giving somebody money. Now a giver should be credited, just as we said. The double entry says that what? The giver, debit the giver and debit the receiver. Now I'm giving out 2,000 to somebody, I'm sending it to somebody's account. So I'm the giver, but then what type of alert do I receive? I receive a debit alert. So that means I'm not credited, I'm debited. And the receiver, who I'm sending the money to, is going to receive a credit alert. So the dual aspect concept explains that. Don't think the principle of double entry is not correct now. Now in that transaction, what you are missing is that in that transaction we have four parties, not two parties. If I'm going to use two parties in that transaction, then it's going to be on the side of one party and on the side of the other party. Now on my own side, if I'm the one sending the money, the two parties involved is that my bank account, my bank, and I myself, my cash book, and my bank. So we have two parties. On the other side too, the receiver, the cash book of the receiver, the main person, and the bank account of the person. So if I'm using GTB account, so GTB and my cash book, we are going to what? We are going to apply the principle of double entry. And on the receiver side, is also going to apply the principle of double entry with his cash book and what? His bank account. Maybe he's using Zenith Bank. So he's going to apply the principle of double entry, and then the principle that states credit the giver, debit the receiver will be correct. So that is what we understand. That's what we mean by what dual aspect concept. Is actually the foundation of what the principle of double entry. All right. So number 2, we have entity concept. Entity concept states that a business should be separated and should be distinct from its owner. That is, a business records, a business expenses, income is not the same without of what its owner. Now, this is what we are trying to say. That is, when the owner of the business is trying to put money into the account, it is going to be recognized in the business as capital or increase in capital. And when the owner is taking money from the business, either taking goods from the business or taking out money from the business, it is going to be recognized in the business records or the business accounts as drawings. Do you understand? So if the owner is actually withdrawing goods, we call that goods drawings, and it's going to be taken out in the trading account, in the final account. But if the owner is taking money from the business, that is going to be recognized as cash drawings, and is going to be what? Is going to be taken out in the statement of financial position, that is balance sheet. Alright, so the entity concept is just trying to say that what? The business is a legal entity. That is, the business is a legal entity and should be separated from the owner. Alright, so proceeding to cost concepts. Now, cost concept, this is also called historical cost concept. Now, what this concept is saying that what? This concept states that when a company is recording the value of the company's assets, it should be recorded or stated at the original price or at the cost price rather than the current or market price. That is, if a company should acquire an asset at a particular price, that price will continue be the price at which that asset is being valued and not the current market price. Let's say, for example, a company acquired a piece of land, let's say a plot of land in 2013 at 1 million naira, and now in 2026, let us say that land is now valued at 60 million naira. The market price of that land is now 60 million naira. Now, when preparing the statement of financial position in your balance sheet, the amount or the price you are expected to put there for that same asset is still the original price at which that land was acquired and not the current market price. That is, it should still be valued at what? 1 million naira alongside with the other properties that you have there, maybe depreciation, then you have the net book value. Alright, so that is what we call the cost concept. That is, a company should continue to value the assets of the company at the original price rather than the market or current price. Alright, so that's the cost concept. So we have the accrual concept, and though the accrual concept seems a bit broad in nature, but then we can still bring it down so that we can understand. So accrual concept states that revenue should be recognized when they are earned and not necessarily when they are being received, and expenses should be recognized when they are incurred and not necessarily when they are paid for. Now, what this is saying is that now, because of that accrual, we have what we call the accrued expenses, and we have accrued income. Now, this concept is permitting businesses that once a business has provided services or sold goods, then revenue has been earned. That is, when revenue has been earned, they should note it. That is, it should be recognized, even though the money has not been received. And you as a customer or as a business, once you incur an expense, once you incur any form of expenses, it should be recognized that you incurred expenses. It should be recognized in your book. It should be noted down. And it should not wait until when those expenses are being paid for. So let us bring that in reality. When we talk about accrued expenses, when we talk about the revenue side, that is, revenue should be recognized when it is earned and not necessarily when it is being received. We are talking about accrued income. Is the current assets to the business. Why? Because let us say, for example, a business has rendered a service to a particular customer or sold goods to a particular customer, but then has not yet received money. Now, the business is permitted, according to this concept, the business is permitted and expected to record it. Because the accrued income will go to your balance sheet. It is permitted to record it. That is, but then the money has not been received. And a practical example in Nigeria is sometimes when they say, though that has been a long time, let's say let me just use an example, don't let me use Nigeria, please. Let's say, for example, you are working for an your employer. So, and you've actually worked for 2 months, and your employer has not been able to pay your salary for 2 months. Now, to you, you've already rendered that services, you've already earned that revenue, but then you have not yet received it. So to you, you know that you have money, but then it's not yet in your hand. So we recognize that as accrued income, And on the other hand, accrued expenses, there are sometimes that you incur the expenses even though you have not paid for it. An example is, or every Nigerian, I believe, average Nigerian do borrow airtime from the network providers that we have, MTN, Airtel, and it is not immediately that we repay or we pay back the amount borrowed. So in that case, once you borrow airtime, it is necessary for you to put it down that you incur the expenses, even though you have not paid for that expense. So that's what we call accrual concept. And that's not all. We also have the prepayment. And the prepayment is also broken down into two. We have the prepaid income and the prepaid expenses. So having prepaid income and prepaid expenses. Prepaid income is a current liability, while prepaid expenses is a current asset. Prepaid expenses just means that you pay the expenses in advance, and while prepaid income is you receive income in advance, and that's the problem too. It's a current liability. So that's under the prepayment. So, but accrued expenses is There's a current liability, where accrued income is a current asset. But what we are saying, what this concept is saying is that a business is permitted to record revenue that have been earned but not yet received, and a business is also permitted to record expenses that have been incurred even though they have not been paid for. So that is accrual concept. So we'll move to matching concept. Right now, for the matching concept, this concept states that the revenue and expenses generated and incurred for any accounting period should be matched with each other, so as the profit or loss for that period be ascertained. All right. This concept, I come again. This concept, the matching concept, states that the revenue generated and the expenses incurred for any accounting period should be matched with each other, so that the profit or loss for that same period can be ascertained. Now, this concept is applied whenever we are preparing the profit or loss account. When we prepare the profit or loss account for a particular accounting period, for a particular year, let's say for a particular year, we are expected that we match the expenses and the revenue that we generated with that expenses and the same accounting period. We know that usually before a business will generate income, expenses have to be incurred first. So when you incur expenses for a particular accounting period, you are going to match it together with the revenue the expenses are used to generate. So the difference between these two is now what we are going to use to ascertain our profit, or let us say maybe we generate profits, we arrive at a profit or at a loss. So that's what we use the matching concept to do. We use it to match revenue and expenses together, income and expenses together, in order to ascertain profit or loss for the accounting period. All right. So money measurement concept. Money measurement concept states that a business or an accountant should only put into consideration only items that has monetary value. Only items that have monetary values. That is, there are some cases that there are some events or there are some items that cannot be measured monetarily. So in that case, we cannot record them. So for example, let's say for example, in events whereby the business management team is poor, or the work rate of a worker is low or something, we cannot record that in the financial accounts. We cannot record that. So we only record transactions or items that have monetary value. For example, salary of a worker, of that same worker, 20,000, and that's the only thing we are going to record. Alright, so these are the 7 concepts I'm going to explain in this video. There are other concepts that I can find, like the realization concept, which I believe has been explained in the Accrual concepts, because it's also saying that what revenue should be recognized when it is earned and not necessarily when it is being received, like that. So that is what we are going to be talking about in this video, and we are done with that. From the going concern to the money measurement concepts, I believe this video has helped you, or is going to help you in one way or the other. And if that is the case, kindly please subscribe, give this video a like, and you can also drop a comment in the comment section. All right, till we meet again.